Hi, and welcome to this week's Money and Market Squawk Call, where we go around the horn with all of our editors to give you their insights on the happenings in financial markets and the global economy. Today is Tuesday, May 6th, and joining us today are Bill Hall, Mike Larson, Larry McMillan, MANDEEP and Doug Davenport. Well, we've seen quite a bit of, divergent data is the way to put it here recently. I figured we could talk about that a little bit, plus give us your insights, your observations on the market. Of course, last week we saw a blowout jobs report on Friday with almost 300,000 new jobs added, well ahead of expectations. On the other hand, the labor force participation rate dropped by 800,000, the lowest level since 1978. And we also saw numbers on the final Q1 GDP, which showed the economy basically came to a standstill in the first quarter. I guess not surprising because they're blaming it on the bad weather, winter weather, which is the fashionable thing to do. But hopefully we'll see a pickup here. Let's go around the horn and see what all of our editors think. Bill Hall, let's start with you. What's your take overall on the markets and the economy right now?
I think we're gonna see a step up in activity over obviously what we saw in the first quarter, but I don't see that we're headed to a rapidly growing economy. I think we're going to finish the year somewhere, in the maybe 2.5% range on GDP. So, in my view, it's sort of more of the same. We had a great unemployment number where we added 288 jobs, and we had unemployment fall from 6.7 to 6.3. But when you dug into the numbers, you saw that what we really had was 800,000 people leaving the workforce. You have some people saying, well, that's natural attrition because of demographics. You have other people saying that that's people just giving up and withdrawing from the workforce. My own view is that it's more on the give-up side than natural attrition. So I think the consumer out there is really struggling. Middle America, it continues to struggle. We have a real bifurcation in our society right now. We know that. The top 1% is doing very well, but everybody else is struggling. And as long as everybody else continues to struggle, and as long as we don't have any jobs growth or real progress in wages, I don't see how we get the economy moving again, because the consumer is 70% of the U.S. economy. For investors, which is what we're talking about, what's actionable for investors is that investors should love this environment, because the Fed's going to continue to do all they can to prop this market up and hope that they can get it going again.
Indeed, we did see U.S. consumer confidence fall in April, dropped just a little bit marginally to 82 and change from 83. Not a big deal, but you're right about that disconnect between consumption and the real economy. Mike Larson, what's your take? I know that you've been kind of upbeat in the economy. We've seen a little bit of mixed data here recently. What's your take right now?
Yeah, I mean, I have been generally more upbeat on the economy, and the news that's come out clearly indicates we're past this crisis environment that we had for 4 or 5 years ago. I mean, we've seen steady progress, whether it's the unemployment rate coming down, whether it's GDP with some hiccups, as we noted in the first quarter, generally improving 2 to 3% pace. Housing has lagged because I think we had a little bit of an echo bubble there, so that's no surprise. The housing market is not leading us out of this recession the way it has in the past. But I think there are other parts of the market that are doing okay, and overall, the economic data is fairly solid. But we're in an incredibly strange market environment, as far as I'm concerned, where we've got the economic data improving, but bond yields continuing to fall this year. Despite that, so you've had this crazy dichotomy where stock prices have generally been rising, but bond yields have been falling. The U.S. economic data has been better than Europe's data, but the euro's been rising against the dollar. And we're at some pretty critical levels here. The fundamentals and the technicals are wildly disconnected. So that means either somebody's dramatically wrong, and we're in for a serious deterioration of the fundamentals, and the technicals are telling you to watch out, or the technical momentum trade is about to get torpedoed by a shift in the data or something else. So very interesting to see. The dollar index, for example, is having an ugly day today, breaking down a little bit here. The euro is trying to break out to a new high on this move. Some of the other currencies like the New Zealand dollar, for example, are breaking out to the upside here pretty strongly. And even as the dollar's falling, though, gold and silver are basically going nowhere. And like I said, bond yields, on the long end have been falling, while at the short end they've been kind of hanging in there. So, you're getting curve compression. In other words, a very, very confusing environment where you're getting mixed signals from currencies, stocks, and bonds, which basically I'm inclined to play things smaller and not make a lot of big moves until we get some more clarity here. The things that should be happening are not happening, which makes you wonder why they're not happening. I think that's why the broader market's spooked as well. I mean, intraday, as soon as the bond yields start coming down, what happens? You see stocks start to weaken. As soon as bond yields firm up like they did yesterday, what happens? The stock market firms up. So I think that stock traders are paying attention to the bond market and saying, what's the bond market seeing that I'm not? Are things about to go to hell in a handbasket, meaning this is an indication of recession, or is something else going on? So again, confusing environment where I think it behooves you to play small.
Yeah, the confusion is definitely, I guess, the key active point right there. You mentioned housing earlier in the, echo bust, as you call it. And we saw last week that weekly mortgage applications fell, I think, another 6% or so, now at a 4-year low. And that's in spite of, as you mentioned, interest rates coming down a little bit here over the last month or so. Is housing in trouble again here as a driver of the economy?
I think I've argued for a long time that I didn't expect a vigorous recovery in housing. I thought that we'd kind of just see gradual, slow, steady improvement over a span of years, not weeks, months, or even quarters. And that sort of trajectory held from 2009 through 2011. And then we got this market where you had a bunch of cash buyers come in, yields were low, and they needed to generate income, and they couldn't get it from treasury bonds. So you saw a bunch of the Blackstones and the like pour into residential housing, buy up houses, and rent it out. It's basically turning housing into another form of junk bond or corporate bond. So that cash buying for yield helped inflate prices. A lot of these guys were tripping on all over each other to buy housing and drove prices up temporarily by some pretty big margins, above and beyond what the underlying wage growth, income growth, economic growth, and so on would dictate. But now many of those buyers have priced themselves out of the market. The spreadsheets don't make sense at higher prices and lower yields. So these guys are stepping back, and housing's falling back as a result. I've never expected kind of housing to really lead us out of this, because I think you're going to have this long hangover period. I don't think the market's going to crash again, but I do think that this echo bust, this loss of the investor buyer, is going to cause growth rates and house prices to come down quite a bit. And you're going to see housing cool, which is what we've seen in the last several months. But again, I don't think that torpedoes the whole economy, because this is not the mid-2000s where housing was, and mortgages and all of that were the driver of the economy, and everything was centered around it. That's not the world anymore. The percentage of GDP made up by the housing market is incredibly small now. So even if housing cools, I don't think it has to torpedo the whole economy like it did back then.
Okay, so a little bit of a housing hangover to watch out for then.
Yep.
Great. Thanks, I appreciate that. Larry McMillan, are you on the call this morning?
I am.
Hi, Larry. How are you? I know you follow the markets very closely with technical and a mix of technical and sentiment indicators. Of course, we saw the Dow hit a new high at the end of last week. What's your take on the market position right now?
Boring. We follow a set of basically 4 indicators. 2 are sentiment-based, and the sentiment-based indicators are just all over the map. They're really, like the put call ratios, the equity-only put call ratios that we follow, one's on the buy signal, one's on the sell signal. So, I mean, it's really, they're just meandering around. Also, market breadth, we follow New York Stock Exchange breadth and also optional stock breadth, and they're giving opposite signals. So the S&P has, I think, touched 1880 for 10 days in a row, or almost touched it anyway, so one way or the other. So that's about as neutral as you can get, too. The only 2 things that I do see are a little bit bullish are volatility. Volatility is remaining fairly low, and I know that that's sort of an overbought situation, but as long as it stays there, the market can rally. If VIX were to get up above 16, that would be negative, but it's really hanging around 13, 14 most of the time. So that's not a problem for stocks. And the other thing is that we did have a narrowing of the breadth differential between NASDAQ stocks and New York Stock Exchange stocks. So that was also a positive sign. But that gave a buy signal last Friday, and obviously not much has happened since then. So it's probably just another kind of sort of random blip on the technical charts. So I really don't have much to say about direction one way or the other. Obviously, if we break out over 1900 on the upside, that would be very encouraging. And as far as support, I guess you could say we have support at yesterday's low of 1867, and we certainly have support at the week before's low of 1850. But it looks to me like we're just going to continue meandering around in that relatively narrow range until something, happens to move us out of there.
Okay, well, we'll keep a sharp eye on those key levels. Thank you, Larry.
Okay.
Let's move on to MANDEEP. MANDEEP, what's your take on the markets?
Hey, good morning, everyone. So it's a continuation of the same sort of theme we've seen. It's a value-driven market. That I agree with what the folks before me have been saying. There's a lot of confusion out there. The data is on the headline numbers in terms of expectations. They seem to be beating. If you look a little bit deeper, as you mentioned about the jobs number, the participation, the wage growth wasn't really there. The creation was there. We had a weak, dismal first quarter in terms of production. We're having we're going to bounce out of that, especially with the leading indicators and the PMI numbers are better than expected here in the U.S. But I don't think we're going to get. There's a bunch of investment banks out there, analysts that are saying that we're possibly going to get in the 4% plus for the year, but with a 0.1 for the first quarter, I don't see how that's going to be possible, considering all the headwinds that we have. Geopolitical is still in
the investment bankers have to be long because they need a good economy to sell their stuff. So
right, right, Bill. So that's why it pays to listen to folks that aren't incentivized by that, like us. I think we had between a 2 and 3% consensus here on the call, and I generally agree with that. I think 2.5% is probably where we're going to end up for the year. Considering a pickup towards the second half. International is still in the forefront here. I think the Ukraine-Russia tensions are causing the bond market catch a bid, rates moving a little bit in accordance with that. Equity markets are following the bond markets, as Mike was saying. I'm watching carefully the small caps because they are trading at such a premium to their larger cap S&P variance, and they're bouncing off of that 200-day moving average, and it'll be interesting to see if they can hold that and move higher as some of these concerns abate. That could be a pretty nice play. Could be set up for something good there. We're watching for that carefully. Our portfolios, as you know, we're cautious and we're looking for value, adding on quality, and watching earnings season, which has been okay at best. I mean, we're still seeing the same divergence in sales and profits. Sales not growing as much as profits are growing. Utilities have been the big surprise. But it makes sense. We had a colder than expected winter. Nat gas, crude, all those heating commodities were depleted. Resources were depleted. We're entering a storage cycle now, but utilities basically beat in sales growth, earnings growth. They surprised in both fronts. That was interesting. Healthcare came in second. Financials were a concern on the heels of JP Morgan and BFA, and you need to see financials participate if we are going to make this record-breaking run higher into the 1900s and beyond. I'm watching for that. I don't think that's going to happen in the near term, but this earnings season is probably not going to be the catalyst for that. We'll see what the risk sentiment looks like after the international abates.
Interesting. So the boring, trendless market, as Larry put it, may continue for a while.
Yeah, I would probably agree in the near term.
Okay. Hi, Doug. Good to hear from you. I know you follow the markets closely on a technical basis as well. So why don't you give us your quick take of the various markets?
Okay. All right. So, excuse me, I'm on my cell phone. I'm at a meeting, a State Bar of Georgia meeting, and I thought I needed to call in. But a lot of what we're seeing out here boils down to, one, the economy, which we're having complete slow growth economy. And such then, if you have a slow growth economy, you've got a weak dollar. And a weak dollar then is pushing up food stuff. You can look at inflation accelerating in food prices. The CRB food stuff index is up 22% year to date. Cattle's up almost 12%, natural gas up 14%, cotton, doesn't matter what you look at, except maybe oil and gold, but everything else that you eat or you live in is getting more expensive, and that's a function of slow growth. All these indicators that came out last week are lagging indicators, and I still think we're having slow growth, and that's why you're seeing utilities do so well. That's why you're seeing anything income-related do well, i.e. TLT, utilities. So any of those kind of yield instruments in a slow growth economy, which is what we're having, that's what people are looking for. Now, yesterday they had the LARSON hedge fund conference in New York, and I always like to watch that because you really get some interesting things out of that. And Paul Tudor Jones, obviously one of the greatest managers in the last 40 years, spoke and said that macro trading has been as difficult this year as he has ever seen it. Now, when Paul Tudor Jones says that, you know that it's got to be a challenging environment for everyone to manage money. Even Jeff Gunlock and a gentleman named Zach Schreiber, who used to be a partner of Stanley Druckenmiller, they both came out yesterday and said if you're long oil, then they both feel sorry for you. I thought that was quite interesting. I hope they're true because I'm short oil right now. And oil should fall down to about 91. It's had a double top here in March and April. So crude oil is not getting any bids this week. We've got the greatest inventory levels of crude oil since 1931 in the United States right now. And when you have a lot of inventory, prices don't rise. In the equity market, I see a nice cup and handle formed right now. Now, whether that will come to fruition, the cup really started around April 22nd. Handles formed right now. We'll see whether we can punch through this rectangle that we've been trading in for the last 2 months. And I'll have to admit, in my 36 years of managing money, I can't remember when the market indices were at such a high, and the tension in the air is so thick that you could cut it with a knife right now. I guess it kind of explains kind of what Paul Tudor Jones was talking about. And I saw this interesting statistic that of the 270 tech stocks that have a market valuation of over $2 billion, that 162 of them have had a 10% correction from their 52-week highs, and only 10 of those 270 stocks are trading at a new high. So, but right now, the pullbacks are being bought. There's buy support, but we're in this rectangle that I talked about in the past. I think we're setting up for a next move, and I actually think that the move probably could be higher out there. And like Bill said about growth, I don't know how in the world anybody's going to see 3 to 4% growth this year. I just don't see how that's going to happen, because you're not going to see job gains, you're not going to see income rise, you're not seeing hourly wages increasing, you're not seeing hourly work increasing. And consumer spending is certainly not going up when you have food inflation the way it is. So I don't know where the growth will come, and that's why you see a weak economy, you see a weak dollar, you see the euro rising, and you see yields on TLT going down. And let's not forget that the last time, 2 times QE was dissolved, or they quit, QE1 and QE2, that's when TLT had one of its greatest rallies, especially the last one in July of 2012. And I could easily see TLT right now rising up to that make a double top that it had in July of 2012. It's around $125 a share on TLT. And then maybe form a double top, and maybe that's when interest rates will bottom and go back up. But TLT still looks very attractive to me right now. The euro still looks attractive. Let's see. Gold's still in a bear market, even though it did break out of a little trend, broke above its downtrend line the other day. But still, I just don't see a lot happening because gold is really in a double bottom. It formed a double bottom. And until it gets about $1,434 an ounce, I just don't see that. If it gets above that, we're back to probably a bull market. But if it doesn't get above that, I think we're just still trading around this area. And so it's still in a bear market until otherwise, and price action will tell me, like any of these investments that we all look at, price action as opposed to narrative tells me where we're going. So that's a long story, but that's it.
All right. Thank you for those insights, Doug. Appreciate you covering all those markets for us. Well, that about wraps things up here for this week's Squawk Call. Some great insights, gentlemen. I thank you one and all. And be sure once again to tune in next week. Till then, I'm Mike Burnick for Money and Markets. Good investing.